About 16% of us go broke. 16%. I just chose not to be a statistic.
Imagine landing your first big contract or nil deal, then realizing up to half your life-changing money could disappear in taxes if you play the game wrong. Most athletes, creators, and side hustlers don't know that once self-employed, there's a hidden 15.3% tax waiting on their profit before normal income tax even shows up. But what if you could copy the same plays the wealthy use? LLCs, S-Corp, smart write-offs, even family foundations to keep more of what you earn. First play. If you're getting nil payments, brand deals, freelance money, or side hustle income, you're usually not an employee. You're an independent contractor. This means you pay income tax plus self-employment tax, which in 2025 is 15.3% for Social Security and Medicare on your net profit. So if you earn $10,000 from nil or side gigs this year and don't plan ahead, roughly $1,500 can vanish just to that extra self-employment tax. Treat every nil check or side hustle payment as business income and open a separate business bank account to keep it organized. Second play. Separate you from your business with an LLC, limited liability company. This helps with legal protection and makes it easier to track income and expenses. If a brand deal goes wrong or someone sues, would you rather they come after your personal savings or a clearly separated business entity? In most cases, form your LLC in the state where you live. For privacy and professionalism, consider a business mailing address or virtual office. Play 3. Once your profit grows, you may be able to switch from just an LLC to being taxed as an S corporation. With a simple single-member LLC, your entire net profit usually faces that 15.3% self-employment tax. With an S Corp, you pay that 15.3% only on the salary you pay yourself, while the remaining profit can often avoid that extra layer. Many pros suggest S Corp status once your business profit reaches roughly $50,000 to $60,000 a year, as admin costs start to make sense at that level. You must pay yourself a reasonable salary and handle payroll and a separate tax return. So this is a talk to a qualified tax pro decision. Now the famous jock tax. Professional athletes often owe income taxes in every state where they play games, not just their team's home state. One analysis found top NFL players can lose more than 45% of their income to combined federal, state, and jock taxes, filing returns in up to 10 different states. Think about that. You could be a superstar and still watch almost half your salary disappear just because of where you live and where your schedule sends you. Your home base, where you're domiciled, can dramatically affect your tax bill. Some states tax income at 0%, others have top rates over 10%. Even non-athletes who travel a lot for work can trigger multi-state filing rules at higher incomes. So knowing the rules matters as careers grow. Play 5. Use the ordinary, necessary, and reasonable rule to turn everyday costs into legitimate business expenses. Tax rules let business owners deduct expenses that are ordinary, necessary, and reasonable for running their business and earning income. Think travel to shoots, cameras, podcast mics, editing software, or part of your phone and internet. If you're already buying gear and traveling for your content, the real mistake is not claiming valid business deductions. Play 6. Instead of just giving money to family or charity, use structure. Hiring family members for real work can shift income into lower tax brackets. Imagine paying a parent or sibling a fair wage for actual work, reducing your self-employment profit and tax, while they earn income taxed at a lower rate. High earners sometimes create private family foundations. Cash gifts are deductible up to about 30% of adjusted gross income. This is an advanced move requiring specialist legal and tax advice, but it turns giving back into a structured, long-term plan. Here's the big picture. Taxes are one of your biggest lifetime expenses, and ignoring them is like playing a championship game with no defensive game plan. You don't need to become a tax expert, but you do need a simple playbook and a good team around you. If you want more breakdowns of how athletes, creators, and high-earning professionals legally keep more of their money, hit like, subscribe, and drop a comment. Run the tax playbook. Remember, everything here is education, not personalized tax advice. always run your own situation past a qualified tax professional before you make big moves.